Welcome to Market Call. Thanks for joining us today. I'm Morella Fernandez. We have a new guest on the show, Tony Ciero, Vice President, Senior Portfolio Manager at Caldwell Securities. He'll be taking your questions today on North American large caps. Here's how to reach us. Call us toll-free, 1-855-326-6266. You can email your questions in as well, marketcall@bnnbloomberg.ca. Tony, good to see you. Thanks for coming in and welcome.
Thank you.
We do have to talk about trade off the top of the show since it is the August 1st deadline, even though the actual installation, the start of the new tariffs announced today would be a week from now. First of all, are you surprised at the rates that Washington has announced? And specifically, what do you think about the Canadian situation?
I am a little surprised at the rates. They're a lot lower than they first came out Liberation Day back on April 2nd. And the markets are reacting accordingly. We saw the markets do quite well over the last couple of weeks, but tariffs has brought it back down a little bit, maybe a buying opportunity. So I am surprised they're a little bit, on average, a little bit lower, 15% across the board. And for those more sanctioned nations in trouble, you see it up and around 35, 40%. Canada, though, yes, a big surprise. It actually went higher, and potentially some underlying issues there with Carney and Trump. So, yes, a big surprise in Canada. I'm surprised they haven't been able to hash out a deal. I think, personally, we should probably get rid of our slogan, elbows up, and just start negotiating, go back on the table. It's worked very well for the EU, for Japan, settling rates in around 15%, the UK about 10%, and we can live with that. We can live 10 to 15%, but if you're starting to see a rise now, 35%, I don't think it's going to bode too well for Canadian equities. So
what do you make of the reasoning given behind that up scale for Canada at 35%? Being because of the fentanyl issue at the border.
Yeah, Trump cited that. It continues being fentanyl issue at the border, but also Carney's recognizing Islamic State as a state for the next meeting that they have. So it's potentially
the Palestinian state.
Palestinian state, sorry. Yes, as a potential issue as well.
And so it's an irritant for the Americans.
I believe so. And the fact that they haven't been able to hash anything out. The other thing, there was no tariffs announced on China or Mexico because they're still in the stage of negotiation. So how could we not get to that involvement ourselves? So there's more underlying issues here, I think, between Trump and us.
Yeah, stuff we just maybe don't know about, but is going on behind the scenes. Okay, so as you mentioned, markets have dropped today. We have seen a lot of these tariff announcements come out, and then there's a bit of a blip. But this one did seem to have more of an effect. What do you think investors are taking away from this?
Well, talking to some colleagues around the office, it's a buying opportunity. The markets have done so well since we got over the hump of the first Liberation Day. Now we're seeing it pull back 1% to 2%. And so it's a good buying opportunity. Tariffs are being announced, and it's good across the globe that you get a settlement, you get a finalization of what the tariffs is, and then you work around that. You continue your growth, whatever you can. In the U.S. case, they're making more deals with the EU, with the UK, Japan as well, in terms of energy needs and efficiencies. So as long as we have a number, we can work with it. Right now in the markets, yes, we think it's a buying opportunity.
Okay, yeah, so it's still a matter of just things not being nailed down so we know what the future looks like. We will line up some phone calls and some emails for you as we head to a break. Tony Ciero here of Caldwell Securities. Again, he's taking your questions on North American large caps. Here's how to reach us today by email and by phone. We're back in a moment. Welcome back, and thanks for joining us. We're going to start with an email right now, which has come in from Leslie. It says, could I please get the guest's thoughts on Enbridge? Tony Ciero is our guest today. We will pull up the Enbridge chart in just a moment. Enbridge has been hovering in the 163 and up range for the past little while. What's your forward look on Enbridge?
Well, when you look at Enbridge, you have to start with the dividend. Very stable, continues to grow. It has a history of 30 years consecutive growth, and going through the tech crisis, continue to grow. Dividends, financial crisis, and COVID. And the reason why is it's solid revenue pipeline. It's regulated, it's backlogged. There's a lot of revenue going forward, and no market pullback can cause any damage to the stock, I believe. So start with the dividend yield of 6%. Earnings growth is expected to be in the mid-single ranges. So couple that with 6% dividend yield, you got a pretty healthy outlook with Enbridge stock. The price of oil has somewhat stabilized this year. It did see a high around 75 back in June, so that gave it a little bit of a lift, but now we're seeing consolidation in around the 60s. So that can have a little bit of impact, but Enbridge, again, has regulated cash flows, revenue stream with the pipeline business, transporting crude oil from west out to the east.
Okay, so constant inflow, so they should be okay. Just wondering, would you buy into the stock at the price it is now? Obviously, I think you're saying hold if you have it.
Definitely hold. It's a name that we have as a long-term stable hold in our dividend model. I would recommend buying it because you are achieving a 6% dividend yield. If you need the income, fantastic. It's tax efficient in Canada. And if you don't, follow a dividend reinvestment plan, a DRIP program, where you just buy more shares. So absolutely buy it today.
Got it. Okay, let's go to the phone lines then. John's on the line today from London, Ontario with a question. Hi, John.
Hi, Marilla. Hello, Tony.
Hi, John.
Just want to get your opinion on going along the theme of the tariffs taking their toll. Which of the Mag 7 stocks, several of them have done very well in the last 2 weeks on report. Which of them do you think will emerge first? My money's on Meta and Microsoft, but I own all 6 of them.
Okay.
Thanks very much for your comments.
Okay, so let's pull up a couple of the charts as we talk. And we had just Amazon and Apple reporting yesterday. Apple had a big iPhone boost. The consideration was maybe people were buying ahead of tariffs coming in. But overall, what's your take on the Mag 7? Which ones do you like?
Well, I'll start with Microsoft. I think that's the darling. Then Alphabet is up there as well. But which one I think will do well going forward is Amazon, believe it or not. Even though earnings disappointed yesterday because investors expected more from their cloud business, AWS, I think now that you have an understanding what tariffs will be going forward, Amazon will price accordingly. And that part of the business, their e-commerce platform, which was driving growth for the Amazon stock for the previous, say, 8 of the last 10 years, will now be more refined. The outlook will be a little bit better, and I think that'll do quite well going forward. So Amazon has had a little bit of issue this year because of the tariffs concerns, but now that we have a number and settled across the world, I think Amazon's primed to do well going forward.
We'll have to see if it moves up because it's down more than 7% today, as you saw after reporting last night. But you're saying their AWS unit should or could be performing better?
Well, investors are disappointed that it only went up at 0.1% in growth quarter over quarter, where Microsoft and Alphabet had stellar performance on their platforms there. So yes, they're spending quite a bit in data storage centers, R&D. So this is going to pay off. Again, Amazon has been hit this year because of the unknown of the tariffs. Now that we have a resolution there, potentially they can do quite well. And on the flip side, yes, the AWS services will eventually catch up. If I draw a parallel, Microsoft last year Q2 earnings really got hit hard as well because investors were disappointed. It's its cloud platform. I believe it's called, its name escaping me.
Is it the Azure platform?
Azure, thank you, Azure platform. Investors were disappointed. There's a lot of cash spend, CapEx spending, and investors were disappointed with that segment, and Microsoft had come down. So I see similarities this time with Amazon, and it's just a matter of time before AWS ramps up again.
I was going to say there's that theme of let's get the spend out and benefit from that down the road. Okay, let's go to Elliot. He's on the line in Hamilton, Ontario with a question. Hi, Elliot.
Good afternoon. Please, down a little bit probably on a potentially weakening consumer. Capital One Financial looks really good. The merger, I believe, with Discovery, Capital's credit with Discovery's global transactions platform, it sounds like a winner going forward to me. What say you?
Okay,
Thank you.
So let's look at Capital One. We'll pull that up. Go ahead.
Yeah. Well, Capital One, you see, it's coming off a little bit here, but it's approaching its year-to-date highs. It is a financial, and it potentially could do well going forward. It has the credit services in there. But if you're looking for something where you want a stable performance and you know it's continuing getting market share, and you're looking at a financial in particular, I would recommend JP Morgan as a substitute. If you're looking more on the credit side, I would recommend Visa or MasterCard over the Capital one. But the caller's question, yes, it could be primed to do quite well here, especially after the acquisition.
Got it. Okay, we are going to take a quick break. We're going to line up more of your phone calls, your questions for Tony Ciero of Caldwell Securities. Again, he's taking your questions on North American large caps, and here is how to reach us. We're back in a moment. Welcome back, and thanks for joining us on Market Call. Let's get to the phone lines. Patricia has been holding. She's on the line from Woodbridge, Ontario. Hi, Patricia.
Hi, good afternoon, Marilla and Tony.
Hi, Patricia.
I have a question regarding, I know you just talked about Enbridge. I have Suncor, TC Energy, and Enbridge. And my Suncor is up quite a bit. I'm up 134%, so I'm doing really well with Suncor.
Yeah, you're doing okay.
Yeah, so I have a question. Is that, do I take my money and run? Do I, hold on them? TC Energy is about 40%, and Enbridge I'm up about 35%. So I'm just not sure. Do I keep all of them? Do I focus on one of them? Do I sell any of them?
Okay. Let's talk about whether you see some forward growth in the stock, and also if you can just expand on the energy sector right now, which does seem a lot more volatile, all things considered.
Absolutely. So my answer to your question, Patricia, is definitely continue to hold it. We still see quite a bit of upside. And Suncor has done quite well this year. I'll go back about 3-4 years ago. They had some issues around employee safety, and the stock got hit a little bit at that time. But they got that all straightened out with advanced programs. Plus, they're trying to go more green with the technology that they're applying. And they're an integrated oil producer. It's not just heavy crude. They have liquid nitrogen gas as well. So you have a nice diversification in there. So I would recommend continuing to hold Suncor. It is one of our core holdings in our North American equity strategy. So we'll be alongside with you.
Got it. All right, let's go back to the phone lines. Bob's on the line. He's calling from Toronto. Hi, Bob.
Hi, Marilla. Thanks for taking my call. I'm just curious about what's happening with IBM. I have made some money on it, but I'm wondering if I should hold it, sell it, or buy some more. I know it's a good company, but it's been tanking the last few days. So I'd appreciate your comments on that. Thank you.
Thank you for the question. IBM has sort of struggled a little bit. Historically. Let me take a look at the chart right now. We'll pull that up. It's at 247.42, down today $5 or almost 2%. What's the challenge for IBM?
Competition. Microsoft has become the darling. If we go back 10, 15, 20 years ago, IBM was the leading technology.
Yeah.
Yes. Now it's too much competition. And if you don't have this artificial intelligence attached to yourself, then you seem to be left behind. So consider switching out of this. And if you want to substitute, look at Microsoft. I would even say look at Apple, now that these tariffs are getting resolved. For potential growth going forward. Okay,
has IBM unveiled any sort of artificial intelligence plan?
I'm not sure about that, but I'm sure they're incorporating in their businesses. Tech companies need to just stay alive nowadays. So, but I'm not sure how that's being utilized.
Okay, and Apple, there were concerns as well about AI and whether or not they're doing enough on that platform. Investors were kind of disappointed about a strategic plan in that unit for AI. Do you expect them to come out with something that's more fulsome?
I expect Apple to fully catch up. They spent a lot of time and effort over the last 8 years or so building electric cars and then scrapped that idea, no pun intended, last year or so. Now I think they'll revamp and move over to artificial intelligence space. They will catch up. They have a lot of cash on hand. Valuation of the company is quite well. Market cap over $2 trillion. So they have money at hand to start to catch up. Will they? They still have the prized possession, the iPhone. Mm-hmm. And yes, we can argue that sales were higher in China before the tariffs come across. But iPhone is a brand in itself, and they continue doing quite well there. But they'll apply more artificial intelligence going forward and ramp up the stock price, I believe.
All right, let's go back to the phone lines. Anne has been holding on the line. She is in Scarborough, Ontario. Hi, Anne.
Oh, hello, Tony. Brookfield Corporation is 3% of my portfolio. Should I buy more? Thank you.
Okay, thank you for the question. Sometimes we don't sort of get a thorough look at what else our holdings are, but Brookfield does pretty well.
Yes, Brookfield, 3%. I think that's an ideal weight. I don't know the rest of your portfolio, but it sounds like it's diversified if you have 3% in Brookfield. I will give you another company if you're looking to add a little bit more exposure. A subsidiary of Brookfield is Brookfield Business Partners.
Okay.
BBU, I believe, is the ticker. And this is the private equity arm of Brookfield. And they've got projects all across the world. I think some waterage, sewage cleanup in Brazil, efficient energy in the UK. So that's a stock I think going forward could do quite well. But hold on to your Brookfield. 3% weight, I believe, is very good. And if you're looking to add a little bit more exposure, consider BBU.
Got it. Okay, let's go to an email then from Alvio. He says, can I get your thoughts on Northland Power? A lot of energy questions.
Yes.
Yeah.
Well, Northland Power is green energy, so specializing in solar, battery efficiency, and wind, of course. And they're a global company. The stock has done quite well since I think the beginning of May because they completed their Oneida, I believe, is named battery plant.
Okay.
In Niagara region, ahead of schedule, under budget as well, and the stock has really popped since then. Now, I like this company quite a bit going forward because they have 2 more projects on the go and expect to be completed in the next couple of years. One is in Poland, the Baltic Power, which is going to introduce wind turbine to Poland, and the second one is out in Thailand in the same wind turbine, and it's supposed to give energy power about 1 million Taiwanese homes.
Are you worried at all about the move away from green energy, given what's coming out of the U.S. and the investments, the big money from the U.S. isn't going in that direction anymore?
Not really. You're still going to have companies with the niche that'll do well. So in Northland Power's example, completing the Niagara project, the battery Oneida plant, they did it under budget and ahead of schedule. So they're producing now the cash flows and they can reduce their CapEx spending, pay out a dividend, so make the balance sheet more attractive. And we believe that's the same thing. Once these other 2 projects, major projects are completed, it'll just improve the balance sheet. You're going to award a stock more for its balance sheet and its performance versus, yes, there can be some macro factors pulling it down, but the company itself looks very stable going forward.
Got it. Okay, let's go to one more email from Janice. She says, just wondering if you would choose Fortis for a stock in your portfolio. Do you like Fortis? Is it something you guys invest in?
Yes, it is. It's a utility company, electrical and gas, and services North America, Canada, U.S., and the Caribbeans. And why we like it, it's a rate-regulated industry. And Fortis, a couple of years, announced about a $25 billion CapEx spend to improve their infrastructure. And for utilities in Canada, they're allowed to charge on their properties that they own, and it's called a rate base. So if their properties appreciate in value, they're legally allowed to charge more. The rate base increases, and I think it'll increase about 6% going forward for the next couple of years, and just means more profit in their pocket. They can pay down debt, improve on their dividend. Plus, I don't think they've ever cut their dividend since they've been around for over 50 years, maybe more.
Okay, so you like them. We are going to take another quick break. Tony's sticking around. No past picks for Tony since he is a new guest on the show, but we are going to look at something else, target asset allocation. Basically, where you put your money and why. We're back in a moment. Welcome back. We don't have past picks from Tony today because he's a new guest, but we do want to talk about target asset allocation. And what is that? Deciding where to put your money depending on your needs, both the short term and long term. Tony, let's start with the asset classes because there are 4 of them, I believe, that you want to consider. If you can just run through them. Yeah,
there's 4 main broad asset class categorizations: cash, fixed income or bonds, equity stocks, and the alternatives. And all 4 have some varying of uncorrelated, low correlated investments towards each other. So knowing how much to put in each one for your investment portfolio, then you've achieved your target asset allocation. And that's what we do at Caldwell for our clients. We try to find out what their target asset allocation is. Okay, so let me give you an example because people are going to be in different stages of their life. So let's say I'm an investor and I have debt I want to pay down
within a year or by the end of the year. How should I structure my assets if I'm in that position?
If your investments are for long term, so you have regular income that you can continue paying down your debt, then you can take on potential a little bit more risk based on your profile. So you want to see a little bit more towards the equities and alternatives portion of the portfolio. But again, to understand how much to allocate across those four main broad asset classes is to get a good understanding of what your risk profile is. And saying risk when it comes to investments is a lot like saying lawyer. There's so many variations of lawyers, but the same thing with risk. And the one we tend to focus on is maximum loss. When 2008 financial crisis occurred and the markets dropped 50% in 6 months, how would your portfolio, how would you react if your portfolio dropped 50% or 25% or 20%? At what point is it, I can't take it anymore, sell everything? We never want to reach that point.
Okay, so let's break that down even more. If I am an investor and I say, yeah, 50%, I could not stomach if that happened to me, but I could handle 20%. Yeah. Does that mean I'm a moderate risk investor or a low risk investor?
Yeah, our analysis shows more of a moderate risk investor.
Okay,
yeah.
So the low risk would be what, 10%?
10 to 15%, exactly. And you're not looking at 2008 for drawdowns like that because fixed income did quite well, especially government securities here in North America. Go back to 2022 when the inflation scare caused havoc on both bonds and stocks.
For rule of thumb, again, just getting back to different people's stages of life, we talked a little bit about if I had some debt I want to pay off. What if I am retiring in a couple of years? What kind of mix should I be looking at?
It fully depends. If you need your income or if you need income for your portfolio to drive income, you probably want to be in that moderate range. But if you have enough assets built up and there's more for the next generation, say, or legacy planning, then you can have more towards the equities and the alternatives, so more of a growth type portfolio. So it depends where your investment portfolio is at the time of retirement.
What if I'm starting out and I'm new to the whole investing idea? I'm just getting my foot in the door with my career. So I've got, 25, 30 years ahead of me. What do I need to know?
Investment knowledge is key and experience as well. So make sure you partner up with an investment advisor to explain the risks. So I would recommend a more aggressive portfolio because you have the time to ride the ups and downs. But understanding the risks behind it and getting a good investment advisor to explain that to you and kind of hold your hand when we see market turbulence like we are seeing today. And you don't sell out of the portfolio too early. You stay for the long run to see the investments through.
I would assume that you should take more risk when you're younger as opposed to as you mature.
Again, it depends the size of your investment portfolio. I talk to very wealthy people that they have a lot more money that they need in their lifetime. So they're looking down 2-3 generations and they want to continue to grow it. So they can take on a little bit more risk as a time horizon. So it's always dependent on the time horizon and ultimately what the goal is for your money. If it's to sustain your lifestyle, yes, and you're closer to retirement, maybe take more of a balanced approach or a conservative approach. But if there's more money than you need, then you can consider more of a growth portfolio because you want to keep that going down the line.
Considering we are today in a situation where the uncertainty level has been sort of up and down since the start of the year with Donald Trump in power, and we know he has another, 3.5 years to go. It's sort of a unique situation for the North American economy. How are you advising investors, and what are the kinds of questions you're getting right now?
Again, we're advising on the asset allocation. If we built a properly defined portfolio, they're able to ride the ups and downs. And yes, we've seen that for our clients. We're meeting a client, cash on hand. We build a portfolio based on the asset allocation, their target asset allocation. But let's not put all the money to work at once. Let's stage it out over the next, several months and take advantage of buying opportunities like potentially we see today.
I was going to say there are some opportunities built in as a result of the uncertainty. Yeah. Okay, we're going to take a quick break. We'll line up more of your phone calls and your emails for when we come back. Stay tuned. Welcome back. Let's go to the phone lines. Jonathan has been holding in Toronto with a question. Hi, Jonathan.
11-year-old investor here. I just want to know your thoughts on Nvidia versus Broadcom.
Nvidia versus Broadcom. Thank you for the question. Jonathan sounds about 10 years old, so he's starting early. But Nvidia versus Broadcom. Nvidia, of course, the tech darling here that has done extremely well after that April low. How do you stack it up against Broadcom?
Well, the clear winner is Nvidia here, and because they produce the chips that makes artificial intelligence possible. And there are some competition out there, and Broadcom, I don't think, is one. So I would say stick with Nvidia and look for a buying opportunity. I think today it's down about 3-4% in line with the markets. So I recommend a buying opportunity. I'll give you a parallel with Nvidia. Intel, back in the day, we used to produce the chips for computing, central processing units. And Intel was a darling as well for many years until, yes, now the chips are not so much known, and a lot of the competitors like Microsoft can produce their own chips. Nvidia still has the market share, and there are companies trying to catch up globally to Nvidia, but I think they're further ahead. So stick with Nvidia and look for a good buying opportunity.
Got it. Okay, let's go back to the phone lines. Elizabeth is on the line in Edmonton. Elizabeth, what's your question today?
My question is about J.P. Morgan Chase. I bought this, just this morning because I like Jamie Dimon.
Yeah.
However, he's written a book, Only the Paranoid Survive, so I'm wondering about J.P. Morgan Chase going forward.
Fairly safe bet, yes?
Absolutely. And Elizabeth, hi from Edmonton. I used to live out there about 20 years ago, so I miss that place a lot. Yes, JP Morgan is a core holding in our portfolios, and we've held it for about 5 years. And it's tough to bet against Jamie Dimon. Over the last several years, he's been CEO for a number of years, but JP Morgan has taken market share from its closest competitors. If you're looking at the market capitalization of JP Morgan, it's approaching $1 trillion. I think it's about $800 billion. The next closest bank is either Bank of America or Wells Fargo, and it's in about $300 billion. So it's more than double its competitor there in the U.S., and they continue to gain market share. So good purchase today, continue holding long term, and yes, let's put our faith in Jamie Dimon.
Why does it continue to take market share away from the competitors? What is it doing that its competitors are not?
I think just staying ahead of the curve in terms of offering investments, more global approach versus U.S.-centric. Staying ahead of the curve. And sometimes you do invest because of the CEO, and Jamie Dimon's done quite well there.
Got it. Okay, let's go to Paul in Orangeville, Ontario. Hi, Paul. Paul, are you there? Okay, I'm going to bypass that. I think he might have put the phone down. We're going to go to an email now from Sandy. Sandy says, can I have your opinion on ARC Resources? ARC Resources is one of those that a couple of analysts have said they'd like moving forward because of the natural gas play if natural gas prices move up, which they think it will. Yeah. Where do you stand first on the price of natural gas and ARC Resources specifically?
Yes, I think natural gas will improve, same as the price of oil going forward, just because of the demand. You need a lot more energy to house these data warehouses being built throughout the U.S., and plus a lot of the agreements now that we're seeing between the U.S. and Europe and the U.K. So there's going to be quite a bit of demand on energy, so prices should appreciate. ARC Resources, though, we have to give credit. Talk about CEO. Terry Anderson took over about 5 years ago, and if you see the 5-year growth on ARC Resources, I think it's about 400%. Although this year it's kind of flat in line with the price of natural gas and oil. But Terry Anderson, when he took over, he just rightened the ship and got rid of some debt, ramped up production, so they've seen record production, debt's coming down, initiated a very successful share buyback program over several years, and they bought back something like 20% of their shares. So led by a very strong CEO, ARC Resources, I think going forward, can continue doing well.
Got it. Okay, let's go to another email from Steve. Steve says, wondering your thoughts about tech resources. So let's talk about tech.
Well, they're a little bit of trouble, and they have the copper mine in Chile. And first, let's start with copper. It's drastically come down, I think, from $9 highs just a couple of weeks ago down to about $4 or $5.
And tariff noise there as well, right?
Absolutely. So that's the first thing. The second thing is their main mine in Chile is having production issues, and costs are coming in higher than expected. And Tech Resources announced earnings last week, and it was okay from a revenue perspective, but investors are not rewarding going forward because they can't get over the hurdle of costs and production issues. If you want to look similar industry, First Quantum will be an alternative to Tech Resources, and First Quantum is just, I don't want to say better managed, but their balance sheet is a lot more successful than Tech Resources.
Got it. Okay, let's go back to another email from Rick. He says, would like to know about Turmaline and why it has dropped so much over the past 2 days. Let me pull up Turmaline and have a look at that. So it is down below the $60 mark at $57.70, down over the past year about 5%. Does this just have to do with the volatility of energy prices, or is there something more going on for this company?
Volatility energy prices, and it's not a large company like Suncor and CIBC, closest competitors that can weather the storm. We do have this as a holding, more of a speculative play. So as long as you have a diversified portfolio, this makes sense at maybe 1%, 2% maximum.
I was going to say, how much would you invest in this company?
It's about 1% to 2% maximum.
And why did you decide to dip in here?
Well, we've ridden this wave, unfortunately, so it was about a year ago. Long term, we think it could be primed for growth. It hasn't shown it thus far, but we're still thinking it's long-term hold. So there's no fundamental issues with the company itself. It just needs to continue ramping up production.
We talked a little bit about the price of oil, where it has been hovering, and we know there are situations with the amount of oil in the system, with OPEC Plus sort of turning on the taps more than they had expected to or said they were going to. What's your take on the forward price of oil?
I think it's primed to go higher just because the energy demands globally. And if you're starting with artificial intelligence, it requires more energy. So I think it's primed to go higher. And even though they're turning on more of the taps, you're still going to have some politically unrest, geopolitical concerns across the world that can spike the price of oil, like we saw back in June with Iran
and the U.S., yeah.
Yes, exactly.
Got it. All right, we're going to take a quick break. We'll line up more of your phone calls for Tony when we come back. Stay tuned. Welcome back to Market Call, and thanks again for joining us. We want to go to the phone lines because Jim's been holding on from Whitefish, Ontario. Hi, Jim.
Thanks for taking my call. Your opinion of CIBC and what, when the stock splits, what the value did the split up? The stock split a couple of years ago. So what value will it split again at? Thank you.
Thanks for the question. Okay, so a little bit in there to parse out. First of all, do you like CIBC? I know Royal Bank is the big darling of the bunch, but do you like CIBC? Do you guys own CIBC?
We like it, and we own it in our dividend model.
Okay.
Yes.
And generally speaking, is this a stock that you expect to see some growth? And he's talking about a split. Do you see that happening?
It used to be a rule of thumb, once a bank stock reached about $100, split 2 to 1. And because of the price of shares, $50 makes it more affordable to buy than, say, $100, but you can the exact same
We've
coverage.
gone past that,
Yeah. So I think we're past that, and Royal Bank's blown right through the $100. They're about 170, 180 right now. The reason why we like CIBC is now that we have an understanding what tariffs will be, 35%, and yes, it's going to create some havoc trying to import our goods into the U.S., but can we grow Canada? Can Mark Carney, instead of having divided interprovincial trade barriers, relax some of those rules? And can we see some growth between provinces? If we do, then I think banks in general are primed to do quite well going forward because they're going to supply the lending for the corporations, for the infrastructure builds, and things like that, and the underwriting for loans as well.
Some had argued that even with interprovincial barriers going down, there's not a significant amount of unleashing that will happen province to province. What do you think about that?
Well, exactly. It's all speculation now, and I want to see barriers taken off. And you look at the U.S., it's the United States for a reason. There is no trade barriers. But we do. We should have some united territory, united provinces as well. So the more we can take off, the more infrastructure we can get across all the provinces, the better Canada can grow. And again, financials will be the the recipients of that growth.
Got it. Okay, let's go to an email from Amy. Amy says, what do you think of Adobe Inc.? What's a good entry point? We've had a lot of questions about Adobe, and I know it has struggled. In my mind, the challenge seems to be, from what I understand, the fact that you have AI doing some of the things that Adobe has historically done. And there is a concern that AI is going to surpass the ability that Adobe gives to creative types, for example, to generate images, that kind of thing. And we are beginning to see in magazines, people that don't exist who are now models in magazines to try and sell you things. So I'm just wondering if you think Adobe still has the same kind of value for an investor that it used to, or if it'll claw back to what it used to be.
My thoughts is no. The value is deteriorated because of low-cost competition out there. Their product prices are too high, and a lot of investors don't think they can monetize in their AI capabilities. Plus the competition. If you're looking at cloud, which they're getting into or are getting into, you can't compete with the Microsofts and the Amazons and the Alphabets out there because they just can pump a lot of money into R&D. The other thing is Adobe got hit a couple of years ago because of the failed acquisition of Figma. And Figma, we know the story from yesterday, up about 250%, I think another 8-10% today. If they had acquired Figma, then yes, I would have put Adobe, great buying opportunity going forward because growth is back in play. But Figma can do the exact same thing as Adobe at a fraction of the cost. So they've incorporated a lot more AI capabilities, and Adobe is struggling to catch up.
And some people had applauded the fact that they've gone to the subscription model, which is recurring income for them, but not enough, you say.
Yeah, if I draw a parallel, Netflix, they had a subscription model back in 2010, and they've always stayed ahead of the curves. As Disney and other online platforms have come up, Netflix has always stayed ahead of the curve. And how so? Did they hire the right actors to produce films for them? Have they got more market share here? So Adobe is struggling to figure out what the answer is, and don't buy it. Once they have a clear direction, trending upwards, then consider get back in. Don't catch a falling knife otherwise.
Okay, so it's not there yet.
Yeah.
Let's go to the phone lines. Bernie has been holding on. He's in Toronto today with a question. Hi, Bernie.
Thank you for taking my call. I have some holdings in Toronto Dominion. I was wondering, is it a good idea just to hold on to this or add to it?
Okay.
Thank you, and I'll listen to your call.
Thank you for the question. So they've had a lot of growth because of the fallback last year, being penalized in the U.S., and its growth cap in the U.S. as well. It's come back quite a bit. Do you think there is more growth to be had by the Toronto Dominion Bank?
My answer is yes. Once they get over the hurdle, obviously what happened last year with money laundering in the U.S. with a company that took over a few years ago, once they get over that and the fine, it will continue to be a Canadian bank. And Canadian banks are protected by the government here in Canada. So nothing's going to happen to TD Bank. It's not going to go bankrupt. And as I mentioned before, same story as CIBC, if we are able to get rid of our inter-provincial trade barriers, then TD Bank will be primed to do well going forward. So, Bernie, your question to add more, if you would like to diversify into the other banks, if you don't own those or the other big four, I recommend that. But if you have and you have a little bit of cash on hand to dump into TD, I would say do that as well because you're going to earn a decent dividend while you wait for the price to appreciate.
Yeah, so they are hovering around the $100 mark, up 53%, but that's over the 5-year, down a little bit today, as some of the others are with all the trade news, but that's where TD stands right now. Okay, let's go to an email from Sharon. Sharon says, out of all the telecoms, would you buy Rogers? I own, and I'm thinking about buying some more telecoms in a much more difficult spot. Because they are also trying to figure out their way forward for income. Rogers, of course, has taken a sports angle to things, owning some teams and sort of trying to capitalize on that. What do you think of the direction they're going?
Well, first off, we like companies that are in multiple segments business out there. And Rogers, obviously, telecommunications, bread and butter. But they've gone into the sports, owning a lot of the Toronto sports teams. So we like that diversification. It is a holding in our dividend model, pays a very nice dividend. So we do like it at that. Rogers and TELUS are incorporating more artificial intelligence into its programming as well. So there's a leg up there, too. So my answer to the question is, yes, look to delve into Rogers. It's receiving a good dividend. and the long-term growth, it's not so much on the cable subscriptions like these telcos used to be in the past. It's more, can they diversify their earnings stream going forward? And the answer for Rogers is yes.
Got it. Okay, we're going to take a quick break. When we come back, Tony will share his top picks. We're back in just a moment. Join us on Tuesday for Market Call. Lauren Steinberg will be on the show. He's president of Lauren Steinberg Wealth Management. He'll take your questions on global value stocks and high-yield bonds. And if you miss Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, time now for top picks from Tony Ciero. His first is Berkshire Hathaway, very well-known name, very well-run business here. Berkshire Hathaway you like because it's consistent, yes?
Absolutely. It's an investment portfolio comprised of public stocks and private companies. And at our firm, we really like the private equity, and it's done quite well. It's going to have a new CEO going forward, Greg Abel, out of Alberta. And when that was announced, the stock has taken a dip. I think it's down about 12% since early May, since Warren Buffett had his seminar, annual general manager.
His announcement, yeah.
Yes, yeah. So, and that's why I like it now. There hasn't been any change. It's not great that Greg Abel just started. He's been there since 2011 under the tutelage of Warren Buffett. So it's going to be smooth sailing. I almost draw the same parallel Apple. When Steve Jobs passed away, it was known that he had cancer and he was going to pass away. And when Tim Cook took over, yes, the stock price depreciated a little bit, but eventually Apple continued doing what it does well. So same with Berkshire Hathaway. This is a great entry opportunity. It's only down because of...
I was going to say, do you think it's just investors being nervous because the brand name of Warren Buffett will no longer be?
Exactly, but the investment philosophy stays. Once that out there, they're set to make about over $4 billion in dividends alone this year.
Yeah.
And Buffett's never, I think he distributed once and he regretted doing that back in the 60s. So they take that money and reinvest in their program versus distributing it out. So just there, you're going to get some pretty decent growth.
Got it. Let's talk about your second pick, which is Royal Bank.
Yeah.
We talked about Royal Bank being sort of at the top of the Canadian banks in a consistent way with the stock. And we have touched on a couple of other banks in this last hour, CIBC and TD. You would still put money in Royal Bank. It's at 177 today, a little bit down. Tell me why.
The main reason, they acquired HSBC Canada back a year or so ago, and we haven't seen analysts fully price in the synergies from the revenue standpoint. You've got now the intellect of more of a global platform. And that's one of the reasons why I think JP Morgan is doing so much better than the US banks. And I think RBC will do the similar kind of growth here. Once you have the global capabilities, you're going to attract more investors with wealth. And then you get more recurring revenues from portfolio management fees, things like that. So we haven't seen the full synergies from a revenue standpoint from the HSBC takeover.
Okay, so it is at, as I mentioned, 180, and it's been fluctuating a little bit above that 180 mark. You think there's room to grow also because of the provincial barriers that are supposed to come down, which could mean more investments in Canada.
Exactly, yeah. Hopefully they come down, and it means more infrastructure opportunities in Canada, and the banks will be winners there because they're going to lend the capital.
Yeah.
They'll be underwriting the loans on the books of these corporations.
Okay, let's get to your third pick, which is Amazon, which reported yesterday. Yep. Yesterday benefited, of course, from the Prime Day deals, which are now over several days instead of one Prime Day. But there was some disappointment in AWS. Yes. Which is its Amazon Web Services. I guess investors thought that they could do a little bit better. It's down today almost 8%. Yep. Is this a company you think is going to bounce back fairly quickly just with this drop from earnings? What's the forward look for you for Amazon?
I'm not sure how fast it'll come back up. But the AWS, the cloud computing capabilities of Amazon, was disappointing. It still came ahead of what the analysts expected, but not to the same tune as Microsoft's cloud computing software or Alphabet's. So they just expect, Amazon will do the same thing as they're spending a lot of money. So they're not seeing the same rewards for all the capital spend that they have. Going forward, yes, Amazon did say they're going to continue spending. I think they spent about 30, 40 billion this year. They committed 100 billion this year, and this is for the data centers to store the energy needed to make artificial intelligence possible. So the rewards will be there. Earlier in the show, I mentioned it's a parallel to Microsoft's Q2 earnings last year, when the Azure cloud brand wasn't up to investors' expectations, and Microsoft dipped about 10, 15% in a short window of time. Since then, the stock is up about 25, 30%. So I think you give it about a year and you see that Amazon prices could be at the same levels, 25, 30%.
And very quickly, you think the tariff has already gone through the online retail business for Amazon?
Yes, now that we have a little bit more conclusion on tariffs, Amazon can price accordingly. Maybe some of it can be transitory, some of it can be passed on to the consumer. But now that we have a clearer direction, Amazon will work around it to continue making a profit on the other side of the business, e-commerce platform.
Got it. We do have to leave it there. Tony, thank you for joining us, and welcome again to the show. This is your first time being here for Market Call. And thank you for joining us on the show today. We'll see you back here again on Tuesday. Have a good weekend.